The Reserve Bank's rate hike was as expected. The stunner was RBI's determination to chase down inflation. First, sample these two statements from the governor and his deputy governor.
India's GDP growth is resilient. It is holding on and it is doing well in a world of slowing growth and possibilities of recession across several countries.
The worst of inflation is over, but the moderation of inflation will be very grudging, very uneven. So we must shepherd inflation first firmly into the tolerance band and then to the target.
Put the statements together. What are the two telling us? The RBI is using the cushion of decent growth to do some hard work on inflation, which it believes is not going down very soon. Bond yields shot up as the market priced in another hike in February. But is that the way to read the policy? Is this the best recipe for the economy itself? Was the rupee weakness an unstated reason for the hawkishness? And how will macros shape up in 2023? For all this, I'm joined by the best doctors of the economy. I have with me Mr. Dinesh Khara, the chairman of State Bank of India, Mridul Saggar, former member of the MPC and now professor at IIM Kozhikode, Samiran Chakraborty, chief economist, Citi, and B. Prasanna, head global markets group at ICICI Bank, perhaps India's best bond market expert. Thank you, gentlemen, for joining me. Mr. Khara will be with us in a moment, but let me start with the man who has been there, done that, Mridul. How would you read this policy, Mridul? The big takeaway for you?
So, Lata, I put it that this policy was priced with destiny, really. I mean, where policymaker views and markets views converged, the quantum of the rate hike was very much there. As you put it, what you called a stunner, yes, that was the only surprise to my mind, that the communication, which the markets were expecting it to be the softer in terms of stance, and I'm so happy that the RBI actually eschewed falling into that trap. Like the guidance that the rate hikes are at the end of its cycle would have been rather bad at this stage because there are three clear reasons which the RBI stated on it. One, the sticky core inflation. One, anchoring inflation expectations was important. And third was controlling the second round effect. I'll add a fourth reason to that the negative deposit rates in real terms are still negative. At the end of the October, the weighted average term deposit rate in real terms had a negative carry of 1.28% as per the RBI data, because 5.49% was the rate weighted for across, and 6.77% was the inflation, which means a negative carry of 1.28%. So it's true that inflation will soften and this negative real rates may roundabout get over in coming months, but it needs to be pushed a little bit forward. So clearly the rate cycle end, not calling a rate cycle end was a right policy decision, and I think markets would adjust to it. But obviously, it will sort of reach a stage where central banks' pivots will come during 2023 at various point of time, depending on the forward-looking data.
Okay. You said this policy made you happy. That makes two of us, Mridul, because I would think that the Reserve Bank has been extremely prescient and outstanding in the way it has clearly enunciated that its goal is to bring inflation to target. And target is not under 6, target is 4. Samiran Chakraborty, what hereafter would you read? When the governor says that, removal of accommodation is not over, should we only assume February hike or should we assume even more?
Hi, Lata. I think the key point for us was that the emphasis on the stickiness of core inflation.
Oh, yes. Yes.
We all understand that this is not a stated objective of the MPC framework, but to bring core inflation into the operative part of the MPC's forward guidance now makes us look at that number much more seriously. So whether RBI will just be comfortable with a slowdown in the momentum of core inflation, or would actually want core inflation to also come down to a significantly lower level, maybe closer to 4%, is something that we need to see. Why this is important is that a inflation basket which has such a high proportion of volatile food and fuel items, if core inflation is not closer to the target, there is always a risk that we will reach that 6% upper limit with even small shocks. So that's where I think this policy is very important, that it is bringing in that core inflation and using a strong phrase like breaking the core inflation persistence. And we are bringing in the possibility of another 25 basis point hike over the 6.5% terminal rate that we already had in our forecast. But making that our baseline view becomes a bit difficult because the timeline for that is April 2023, which is still far way off, and a lot of things can change by then. But if core inflation momentum does not recede by April 2023, then we will not be surprised if the RBI goes one notch higher to 6.75 from the current baseline view that we have of 6.5.
What's your forecast now on core inflation? I mean, I have never collected that from you separately, but is it receding from 6 by April in your estimate?
It is coming off because what we typically would try to model core inflation on the back of output gap. And the output gap is going to close down by end of this fiscal year. But then next year, since we are baking in the lagged impact of monetary tightening and the global recession, the output gap might become slightly negative again. And in that context, the core inflation momentum should also slow down. But it looks like even for next year, the average core inflation could be between 5 to 5.5% and not closer to 4% unless there's significant global commodity price corrections.
Okay, fair enough. Okay, now for the man who has to make money for others and for his bank, Prasanna. Prasanna, what were your takeaways? And now where do you see the 10-year, the OIS, etc. Ranging? Do you see more yield jumps?
So I think, Lata, first thing, I think what the policy did is to signal to the market participants, all the stakeholders, that stop looking at just the US rates to decide on where the RBI policy is going to be and start looking at Indian inflation very closely. I think that to me is a very, very important statement, because somewhere in the last 2 years post-COVID, our focus on the 4% inflation target, for all the right reasons, kind of got diluted, and we were okay with the 2 to 6% kind of a range. And we were also sometimes okay with the fact that due to the health reasons and due to the fact that it is a really big scare, we were even okay with a inflation of higher than 6%. And like I said, for all the right reasons. But I think right now, since economy is reasonably doing much better than most of the other economies, I think it's the right time for RBI to get the focus back on what we call as a 4% inflation target and not just the 2 to 6%. And that, I think, is what this policy has done, number one. And number two, what it has done, like I said, is also to bring the focus back, like Samiran said, on how the inflation trajectory is going to go, how the core inflation, more importantly, is going to move. So from that perspective, I think a lot of expectations which were built in prior to the policy that the Fed is going to slow down, Fed's pivot has almost happened, so RBI's pivot will happen. So it's a dovish hike that we are going to expect. All those expectations have got delayed. And I think now he's basically put us all on tenterhooks again to look at where going forward our inflation is and growth. That's basically where the growth inflation dynamic is. So from that perspective, I think I would kind of agree exactly with what Samiran said, which is to say that the next 25 basis points points is kind of a certainty in February. But by the time the policy after that, so which means we'll go to 6.5. And by the time the next policy happens in April, in all probability, the Fed would have probably pivoted and would have probably paused or looking to pause. So that is the only uncertainty that I can see. But otherwise, if you look at the inflation trajectory and the fact about real rates that Dr. Patra spoke about, it's pretty clear that they have to keep rates at a higher level and maybe go to something like 6.75 or so. So from that perspective, I think a lot of repricing is happening in the market, but at the same time, a lot of other things are also happening in the global markets. Like you would see that the US bond yields are now unable to go beyond 360. They are again coming back towards the 350 mark on the 10-year at least, even though the 2-year is pretty much on the higher side. And even though you have a Fed futures expectation of a 5% Fed rate, and you've also seen the crude oil prices, coming down, crashing, I should say. So these things are the opposing effects which are kind of ameliorating each other. Okay. And hence, I think the repricing is constantly happening. I would say that for the month of December and maybe till the budget, we don't see 750 also. I would say 740 as the kind of peak, 720 to 740 as a range. But then when the budget comes, the budget arithmetic will then determine how bond yields move beyond that.
Okay, very quickly then, Prasanna, do you think it's very clear now deposit rates, at least in some big banks, will have to start moving up? I will get Mr. Khara sooner or later to speak about that. But do you think the amount of money that was going into the stock markets or into risk assets in general may start decreasing as interest rates start becoming attractive, as debt starts becoming attractive?
Yeah, so Lata, I think there are two different arguments. One is if you're looking at an incremental investment options for an investor at an 8%, let's say 8% fixed deposit rate. No, most of the banks are still not at 8, but I'm just giving it as an example. If you talk about an 8% fixed deposit rate or a debt return of 8% coming from a mutual fund, definitely is a serious threat for the kind of returns that you can potentially make in a risky instrument like equities. And that itself by itself calls for an asset allocation which shifts from equities towards debt. So that is one part of the argument. Yes, on an incremental basis, yes, it makes the case weaker for equities and makes the case stronger for fixed income as deposit rates keep increasing. But on the other hand, a lot of discussions have also happened, Lata, in the media and various other places about the small savings mobilizations and equity market mobilizations actually impacting banks' liability growth. But I think what I would say here is that technically it's only the CASA which the banks get should not be impacted at all by this, because ultimately this money, even though it goes to small savings, it comes back to the system when the government spends, or when it goes into equity mobilizations, that also comes back to the banking system in the form of current account deposits. So yes, while term deposits of the banking system is getting impacted because possibly getting impacted that too because of the equity mobilization, the overall banking system deposits can only can only go down if either a current account deficit happens or if the CICI increases.
No, very short, very quick answer. Do you think that the money going into stock markets could recede a bit? Yes or no?
Yeah, I thought I did answer that.
Yeah, that's right. Okay, you think debt becomes...
Incrementally, it makes the case weaker.
But debt becomes attractive.
Yeah, incrementally, debt is becoming on the margin more attractive than equity as the deposit rates increase.
Okay, I'll run for a mandatory break. Back with much more, especially on the rupee.
CNBC-TV18, celebrating 23 years of business leadership.
अब पापा देखिए, आप लोग को छोड़ के मैं कहीं नहीं जाने वाला।
छोड़ने की बात कौन कर रहा है? अरे यहीं पास में कोई एक घर देख लो। वैसे भी हम कब तक तुम्हें झेलते रहेंगे?
सच्चा दोस्त वही जो आपके बारे में सोचे। होम लोन्स फ्रॉम IDBI बैंक। बैंक ऐसा, दोस्त जैसा।
अगले एक साल में हमारा प्रयत्न रहेगा कि G20 नए विचारों की परिकल्पना के लिए और सामूहिक एक्शन को गति देने के लिए एक ग्लोबल प्राइम मूवर की तरह काम करे।
G20 के नेतृत्व से अब भारत करेगा वसुधैव कुटुंबकम को साकार। इसके हैं कई पहलू, जैसे डिजिटल ट्रांसफॉर्मेशन, लाइफ जैसी नई पहल, इंक्लूसिव ग्रोथ, महिलाओं के नेतृत्व में विकास। G20 की बैठकें होंगी भारत के विभिन्न शहरों और राज्यों में, ताकि हमारी अद्भुत विविधता और समृद्ध परंपरा का मिले भरपूर अनुभव। लोकतंत्र की जननी भारत करेगा G20 की मेजबानी। तो आइए इसे बनाएं वैश्विक बदलाव की शुरुआत। वसुधैव कुटुंबकम, एक पृथ्वी, एक कुटुंब, एक भविष्य।
सुनो, फिर से शादी कर ली। अब तो मैं रिटायर होने वाला हूँ, उसके बाद तो टाइम ही टाइम होगा एक दूसरे के लिए।
पर रिटायरमेंट के बाद लाइफ इतनी इजी थोड़ी होगी। HDFC लाइफ एन्युटी।
रिटायरमेंट के बाद भी सैलरी मिलेगी।
HDFC लाइफ एन्युटी प्लान्स दे लाइफ लॉन्ग इनकम, ताकि रिटायरमेंट के बाद भी लाइफ पहले जैसी ही रहे। HDFC लाइफ, सर उठा के जियो।
Making the future truly forward and charting a path towards gender parity.
This really depends on the leadership of the organization, and I do find that organizations where the leadership is really thinks of achieving this objective of having gender parity, and not only gender parity, diversity in general, then things get done, things get executed, because the policies are framed to achieve that objective. So I think it's very important that there is a commitment by the leadership of the organization, men or women, whoever it is, to this cause.
A mega initiative to make gender parity an attainable reality. HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective.
मुथूट फाइनेंस पेश करते हैं गोल्ड लोन मेला। गोल्ड लोन लेने पर पाए सुनहरा मौका कपल के लिए फॉरेन ट्रिप जीतने का, और साथ ही जीते कई आकर्षक इनाम। यही नहीं, हर ट्रांजैक्शन और कस्टमर रेफरल पर भी मिलेगा 24 कैरेट खरा सोना। आज ही कॉल करें 1800-313-1212।
CNBC TV18, celebrating 23 years of business leadership.
The Reserve Bank announced an as-expected 35 bips rate hike, but stunned the market with its hawkish tilt. We've been discussing the policy with former MPC member Mridul, Saggar, Samiran Chakraborty of Citi, and Prasanna of ICICI. And now we are joined by the biggest person from the banking industry, Mr. Dinesh Kumar, Khara, Chairman of State Bank of India. Mr. Khara, thank you very much for joining in. Well, I'm not asking you your own ALCO and when it will meet and what the rates will be. But do you think at the moment deposit rates also have to go up?
I think deposit rates will be a function of how we look at our asset liability mismatch. So I think we are very closely looking at it, and what the position is, based upon that, if need be, we'll calibrate our deposit rates too.
Okay. I mean, until now, every rate hike meant that for the banking system, margins improved because there was enough surplus liquidity. You didn't have to push up deposit rates. In fact, the governor gave some data of 200 basis points. Only 46 basis points of hike has been passed on to legacy deposits. So do you think now it will be more, or do you think banks can still enjoy a quarter or two of good margins?
No, I think as far as margins are concerned, because a very significant portion of the book is linked to either external benchmark or to MCLR, which will actually pan out in terms of our earnings over a period of time. EBLR, of course, gets factored into immediately, but MCLR, it gets impacted over a lag of time. So from that point of view, I think we still have good time in terms of improving our margins even going forward as well. Okay. That's how I
yeah, you know, the rate of loan growth at over 17% for the industry is really steamingly fast. Now, every time the Reserve Bank points to high inflation and hikes rates, it wants the economy to slow down. Do you think this hike is enough to slow down credit growth even marginally?
We'll have to wait and watch, because this will be a function of the demand.
And if at all that the demand slows down, then perhaps we'll get to see some kind of a slowdown. But I think the kind of growth which we are aiming for, this is, if at all not 20%, but somewhere 14 to 16% is something which is a reasonable growth which should happen in the advances.
What's your sense, Samiran? This is 17% is something we haven't seen in a decade. You think it can slow down? You think growth slows?
The fact is that next year, the nominal GDP growth, we are all expecting to be somewhere around 11% or so. So if I apply the commonly perceived notion that nowadays credit growth tracks the nominal GDP growth somewhat more closely, then we should be coming down to low teens or around that nominal GDP growth mark on credit growth next year. And in some sense, the deposit growth should also increase from this year's level if the balance of payment situation is not as bad next year as it was in the early part of this year. So both credit growth and deposit growth should converge to some extent next year around that nominal GDP growth mark.
Okay, fair point. Since you referred to balance of payments, let me just ask that Rupee question as well to Mridul. Mridul, although the Reserve Bank will say, as it ought to, that only domestic reasons propelled the rate hike, was not Rupee a reason? Was not our excellent growth and consumption pushing up imports a little unsustainably? Isn't that one good reason why the rate hike is pushed and is going to get pushed more?
So, Lata, I think Governor made it very clear on this issue. He didn't say that the Fed rate hike cycle doesn't matter. He did say that the dollar sort of things matter. But he says primarily it is the domestic factors which are driving RBI to raise the rates. And that, I think, is the correct position on this. So when you are worried about dollar, yes, that could be one of the contributory factors, but not the primary factor. And clearly, as he is very clearly articulated, and all of you have noted, that the inflation target is 4%. It's assigned by the parliament. It's the framework is through the Parliament Act, and it is assigned by the government. And so the Reserve Bank would try to push the inflation down to 4%. That's the right thing to do, unless the growth completely gets derailed.
But so more specifically, they may want to curb consumer imports, right?
I think that's important. Clearly, that would help rebalance the macro in a beautiful way if that happens. You know, in this whole equation, we have to be cautious of the fact that exchange rates have non-linearities attached to it.
Okay.
And that non-linearities can play in a big way if the global slowdown comes. If you notice the data which came out of China's imports today, they have contracted 10.6% in November. That's a big contraction on top of a 0.7% contraction in October.
Fair enough.
So things are slowing down everywhere. And central banks are dialing down the quantum of rate hikes very rightly.
Yeah.
But the pivot is not the stage which can be implemented at this juncture in India.
Got it. Mr. Khara, you think the slowdown in credit demand can come from retail, or will it come from exporters and importers? Can you smell any sense of trouble anywhere, or even for that matter, bad assets?
I think exports is something which, of course, has not grown as well. So, and essentially on account of the external demand. So I think that is one sector which might witness some kind of a slowdown if at all the global situation remains as it is. So I think that is one sector. But I think retail perhaps may not slow down. This is what my sense is.
Okay.
And corporate, of course, I mean, so long as demand is there, corporate, I think since they are not now accessing the global markets for raising loans, they are dependent more on the domestic markets. So I think we will continue to see a reasonable demand from the corporate cycle.
Okay, so
from the corporate side.
from then two final questions to the bankers here. Prasanna, do you think the cost of capital for corporates goes up? Right now, the market rates for corporates was not much higher than what government was getting in terms of interest, the spread over the government securities. You think that will rise now? There will be tightness for corporates to borrow?
Yeah, so Lata, in terms of spreads, I think it's a fair call to take that we are still not at the kind of spreads which were in existence prior to COVID, which is, you can call it as a normal world. And the spreads are much, much lower on account of the fact that there has been a huge amount of deleveraging which has happened and corporates have not been borrowing at all. And the government has been borrowing on the higher side. So while we do feel that the corporate spreads will gradually go up as we go forward, but the absolute level of yields, whether the cost net for the corporates is going up or not, will also depend upon which stage of the cycle we are in and where government bond yields are going. And like I said there, that seems like a range in government bond yields even now. I think the budget is what is going to set a very clear trend beyond that.
Okay, so cost of capital rises for corporates. Mr. Khara, you would agree?
Yeah, I think cost of capital will certainly be on the rise for the corporates.
Okay.
The cost of borrowing, cost of capital, both will be on the rise for the corporates.
Okay. Actually, out of time, sir. But let me ask one quick round to all of you. Is the peak rate 6.5 or 6.75? From what we know today, Mridul?
6.5 for sure.
Okay.
Rest will be forward.
Now, give me one answer. 6.5 or 6.75?
I can't give one answer because it will remain data dependent still.
Okay.
But 6.5 is for sure, and remaining will depend on how much of global growth slowdown.
Okay, I'm out of time. That's why I want a rapid answer. Samiran?
The 6.5 still.
Okay. Prasanna?
6.5.
Okay. Mr. Khara?
Function of inflation, but I think 6.5 seems to be a possibility.
Okay. 6.5 at least seems to be the answer from our guests, but they're not ruling out 6.75. It's an interesting discussion. I'm sorry the time is up. Thank you very much, Mr. Khara, Mridul, Samiran and Prasanna. And thank you all for watching.